Hey, welcome back everybody. My name is Casey Kepley. You're tuning in to howtoPlayStock.com. Today is September 12th, 2016, and in today's video I'm going to cover the topic of saving your money and holding on to cash versus hedging your money or protecting your wealth, okay, because there's a big difference. And the reason why I was thinking about shooting a video on something like this is because right now, let's just face it, we're in some of the most unpredictable financial markets the world has ever seen. There's a lot of volatility. This year's been, a pretty bumpy ride in regards to that. And I think it's important that, as an investor, you need to know the difference between holding on to cash and hedging, and why I think hedging would be a better way to protect your money and your wealth, and instead of holding on to cash. Okay, so I'll go into detail in the video here, and I'll explain why that is. But keep watching the video, because in this next part I'm going to cover the dollar standard. I'm going to cover fiat currencies and real money, and I'm going to kind of explain the difference between those two, so that you can get a better idea of why it's better to go ahead and try to hedge versus holding on to cash. Okay, so covering the topic of saving money versus hedging to protect your wealth, we're going to start out, and I'm going to give you a brief history on our financial system, and I'm also going to cover currencies versus money, because I think it's very important if you're an investor or if you're playing with the stock market. You need to know the game that you're playing, okay? And that's what I'm going to show you today, is kind of the dirty little secrets to money, and that way you understand when you're investing in paper assets what you're dealing with, okay? Because if you don't know what you're dealing with as far as the currency, how the monetary system works with the finances behind it, and the monetary policies, if you don't understand any of that, you are going to get burned, all right? So starting off here, I'm going to give you some brief history. So basically, in 1971, all right, Richard Nixon took us off of the gold standard. All right, so he depegged the U.S. dollar from gold. Okay, and from that point on, the U.S. dollar lost its value pretty much overnight. Okay, and it was destined from that point on that the true value of each dollar in your back pocket would eventually hit zero. Okay, and it's because it's backed by nothing. It's not worth the paper it's printed on. All right, so keep that in mind, because I'm gonna bring that. I'm gonna come back to that here in a minute. So, with knowing that, and knowing that the dollar has no value, okay, from that point on, the dollar was considered a fiat currency. All right. Now, if you look at today's markets, every single country is on fiat currency. It's backed by nothing. That goes for Japan, that goes for China, Russia. Every single country is on a fiat currency. All right. Now, the question you need to ask yourself when you're looking at currencies is, how much stuff does money buy you? How much stuff does the dollar bill buy you? That's what you need to be asking yourself. Anytime you look at an asset or an asset's price, whether it be a stock, real estate, whatever, you need to look at how much stuff does the currency or the money in my back pocket buy me. All right. Now, I'm going to cover the differences between money and currency. Okay, so now I'm going to break down the money versus currency and the difference between those two. Before I get started on that, what you need to know is money maintains its purchasing power. Okay, now with that, in regards to that idea, if you think about what I just said in regards to currencies are designed to go to zero, then you know that they're not backed by anything. They're not worth the paper that they're printed on. Okay, therefore, they don't have any value. They lose their purchasing power. All right. So money, on the other hand, these are the components that make up money, and this is defined by monetary policy within governments around the world. Okay, so money is considered a store of value. It's a medium of exchange. It's a unit of account. It's portable, durable, and fungible. All right, and fungible meaning it can be exchanged. So in other words, like if I gave you a $20 bill, you could exchange it and give me back 2 5s and a 10, and it's still $20. So that's what fungible means. The last part for money is it has intrinsic value, and intrinsic value means it's something that can't just be replicated or printed out of thin air like money. All right, it has to be either dug up out of the ground like gold and silver, or it has to be built like a house. When it comes to real estate, it's something that can't just be duplicated overnight. All right, therefore, the value is maintained, and a lot of times the value will go up against other assets. All right, so that's what you need to know about the difference between money and currency. Currency, it has all of these that money does, except for it has no value, and it has no intrinsic value. All right, therefore it's not real money. Okay, and with it not being money, all right, I'm just going to list out a few different things here that are, key takeaways. So basically, no country, all right, is using real money at this point. And from 1934 to 1971, before Nixon took us off of the gold standard, we were in the Bretton Woods gold dollar system. All right, and gold was fixed at $35 an ounce. Now, if you look at the gold price today and what it's priced at, it's much, much higher than that. It's at like $1,330 as of today. So that tells you just, what's taken place when it comes to the value of the dollar and placing it up against real assets or real money. All right, because if you look back in history, over the last 5,000 years, there have been assets that have been used as money, such as gold and silver. All right, and gold and silver are money, because if you look back in time and you study a little bit of history, you'll find out that countries used it as a form of exchange for the last 5,000 years. And if you don't believe me, you can go look at the video that I'm going to put in the link in this description. It's by Mike Maloney. He's an expert on gold and silver, and he discusses in the video, why countries have always went back to gold and silver in times of financial crisis, or in times when governments basically will run up their monetary policy and print so much money that they devalue the value of their own currency. Okay, now this has happened several times in history. It's happened in Argentina. I think within the last 150 years to 200 years, it's happened to multiple countries. I won't say it's in the double digits or triple digits when it comes to countries that have basically driven their currency from something of value to zero, all right, and then had to restart, go with a new financial system. So these things happen pretty often. And if you look back, Bretton Woods was set up in 1934, and it ended in 1971, which means we went to a new financial system. Okay, so from 1971 to now, we're in just the dollar system, and that's just strictly printing money. Now that's going to have to come to an end eventually, and with all the money that we've printed just in the last 8 years, it has doubled what it took the first 240 years of presidents doing when it comes to printing money. So in just 8 years, we have doubled the amount of money in circulation that existed in the previous 240 years. We did that in 8 years. It's unsustainable. It can't go on. So something's going to have to happen eventually. Okay, I don't know when, but I can tell you right now, if you pay attention to a lot of the financial experts out there and investors, they'll tell you the same thing. Check out guys like Jim Rogers, Mark Faber, Bill Holter, Bill Gross is another one to pay attention to, because he's they call him the bond king. All right, and he talks about debt, and guys, that's basically what our system is set up for, is to create more debt. because without the debt, we don't have a financial system. All right. Just to give you an example real quick, for every dollar that you invest in the bank, they're allowed to take a fraction. It's called the fractional reserve system. They're basically allowed to take 10% of that, whatever you give them. They keep it in reserves, and they lend out 90% of the rest of it, to other people in the form of loans. Okay? And that's how money is created out of thin air from the banks. Well, the same thing takes place through the Federal Reserve with, exchanging bond notes with the Treasury. So, again, go check out the video that I'm going to leave in the description here by Mike Maloney. He explains it way better than I do because he's an expert at it. But those were some of my takeaways from it. And the reason why I say you want to save, you don't want to save money, you want to hedge against it, is because if you're saving money, guys, that's stupid. It's idiotic. Why would you save money knowing that it's going to go to zero? Why? And if you know that, then you need a hedge. Get into things like gold and silver, because gold and silver historically have always gone up in value when you place them up against just fiat currency. All right, and to prove it, I just actually showed you $35 an ounce was the gold fixed price back in 1971. It's now $1,330 an ounce. So I rest my case. Okay, that's all I have for today on saving versus hedging and why you want to hedge your money to protect your wealth. Get into hard assets, and especially now, because right now these central bankers don't know their head from a hole in the ground. They really don't. They know what they're doing. They have a plan. But again, that plan, I honestly believe, is to run our currency's value down to zero. All right? I could be wrong, but just given the last 8 years and what they've been doing, it's pretty obvious. And right now, they're stuck. They don't know whether to raise interest rates or to lower them. You just have Ray Dalio come out, okay? He owns the world's top hedge fund. He came out and made a statement to the central banks and said, "You guys better be careful because you're playing with fire." Okay, he didn't say it in those exact words, but he basically said, you're playing on a very, very tight string. If you raise interest rates, you might pop the bubble, all right, that we're in right now with stocks. And again, it all comes back to what I was saying. Whenever you look at a paper asset, such as the stock markets, with shares of a company, you always want to look at how much money in my back pocket, will that buy? How much will it buy? How much stuff will it buy? Okay, how many shares will it buy of some company in the stock market? Because I can tell you, if you look at PE ratios are a great indicator to let you know whether or not the stock market is overvalued or undervalued. Okay, and if you look at the S&P 500 index right now, the PE ratio on that is about 26. Okay, it should be around like 10 to 14, and it's not. So anytime you get stocks overvalued, according to an index like the S&P 500, the stock market is in a bubble. Therefore, you probably shouldn't invest. You should probably just wait. Get into hard assets, get into real money, because you can make the transfer of wealth from real money back into, the currency we're still in if the stock market drops, because prices will come back to fair value. You can then jump in with more money because the value of other assets that maintain their value go up. So you make the transfer. You transfer out of your gold and silver at the peak, take the cash and more dollars, and you go over here and you buy up other assets at a lower value than what they were, maybe fair value. Okay? And that's how people get wealthy. That's how the 0.01% and the 1%ers continue to get wealthy, because they understand the game they're playing. And you need to understand the game too. And that's what this video was all about. Thanks for tuning in, guys. My name is Casey Kepley. You're watching howtoplaystock.com. If you have any questions or concerns, you can leave comments in the comments section below. Also, like and share this and subscribe to my channel, because I'm basically creating a video every week right now. Usually it's on Fridays because I'm busy with school, and that's kind of taking up a lot of my time. But subscribe to the channel because I'm putting out new information on a weekly basis and helping you guys understand what it takes to become an investor and what you need to look at when it comes to, playing stocks. Okay? I'll talk to you guys next time. And remember, income's the outcome.